All right, crypto enthusiasts, buckle up. The market is moving at warp speed, and you absolutely need to know what's happening right now. We've got seismic shifts in institutional power, a dramatic rebalancing of investor fortunes, and regulatory landscapes being redrawn before our very eyes. Forget everything you thought you knew about the upcoming altcoin season, because the playbook has been rewritten. Plus, we're diving deep into the surprising forces propping up major assets while whales make their moves. You don't want to miss a single second of this. It's all happening, and it's happening fast. Stick around, because the Bitcoin Bulletin is live and we're breaking it all down for you. First up, the 2025 altcoin season is not what anyone predicted. Forget the retail frenzy. We're talking about a new era where political connections and institutional backing are the real drivers, and the ripple effects are already being felt. Then, we'll look at a massive exodus from one major asset class as investors flock in droves to another, completely flipping the script on market dominance. We're also exploring how regulators and global markets are in a high-stakes race to define the future of a multi-trillion-dollar digital landscape, and what that means for you. And finally, we'll uncover the surprising retail power that's holding strong against a tide of institutional selling, creating a critical inflection point for a major player. You're tuned into the most important updates, so let's get into it. Don't forget to smash that like button, subscribe, and ring that notification bell so you never miss an update. A new era dawns, altcoins reimagined. Get ready, because the 2025 altcoin season is shaping up to be unlike anything we've seen before. Forget the wild, retail-driven speculation that characterized previous cycles. This time around, the game has fundamentally changed. We're looking at a landscape where political influence and robust institutional backing are the new superpowers, dictating which tokens will soar and which might falter. This isn't just a minor shift. It's a paradigm transformation that could redefine how you approach altcoin investments. The catalyst for this dramatic pivot appears to be the recent volatility experienced by Bitcoin in late August 2025. After a brief but intense surge toward $117,000, a massive sell-off by a significant whale, offloading 24,000 BTC, sent shockwaves through the market. This triggered a sharp decline in Bitcoin's dominance and a broader market correction. While Bitcoin managed to stabilize around $111,000, many altcoins, including Ethereum, saw substantial drops. Analysts are now viewing this period as a critical turning point, potentially signaling the true commencement of alt season. Notably, Bitcoin's dominance has dipped below 60% for the first time in months, a historical indicator that often precedes a significant capital rotation into altcoins. The current altcoin market is already showing signs of this concentration. Solana, Sol, is emerging as a frontrunner, bolstered by its technological advancements and, crucially, its political connections. The launch of a Trump token directly on the Solana blockchain, coupled with its potential for spot ETF approval, positions Sol as a key player. Technically, Sol has demonstrated bullish momentum, breaking through key resistance levels and forming an ascending triangle pattern, with analysts projecting ambitious price targets. Similarly, Ondo, representing the burgeoning real-world asset RWA narrative, is poised for growth. By tokenizing U.S. treasuries and money market funds, Ondo offers a bridge between traditional finance and crypto, attracting institutional interest, especially with potential policy shifts favoring alternative assets. Beyond these frontrunners, other tokens like Tron TRX are benefiting from their integration into U.S. stablecoin infrastructure and historical ties to politically significant networks. Sway, backed by investors with alleged Trump-era connections and now part of World Liberty Financial's strategic reserve, is also on the radar. Even Dogecoin Doge, while a meme coin at heart, could see a revival driven by its cultural resonance and high-profile endorsements. The market structure is also reflecting this trend. The top 10 altcoins now command over 70% of the total 3Es market cap, a stark contrast to the more distributed market of 2021. This consolidation suggests that only the most established and politically aligned assets are likely to capture significant capital, leaving smaller tokens struggling to gain traction. Security is also paramount, with cold wallets and secure interaction protocols becoming essential as volatility increases. This alt season is decidedly more selective, with political and institutional currents carrying far more weight than retail sentiment alone. But the story of institutional power is just one piece of the puzzle. What happens when investors start pulling out of one major digital asset to pour into another? We're about to find out as we dive into the surprising ETF flows that are flipping the script on market leadership. ETFs in flux, Ethereum surges as Bitcoin sees outflows. In a dramatic turn of events, shaking the foundations of the digital asset market, US-listed spot Ethereum ETFs have witnessed an unprecedented surge in investor interest, absorbing nearly $1.83 billion in inflows over the past week alone. This staggering figure starkly contrasts with the mere $171 million captured by Bitcoin ETFs during the same period. Over the last 3 weeks, the trend has become even more pronounced, with Ethereum ETFs attracting a massive $13.6 billion, while Bitcoin ETFs have experienced substantial outflows totaling over $800 million. This significant capital reallocation highlights a powerful shift in institutional demand, with Ethereum ETFs, particularly BlackRock's iShares Ethereum Trust, ETHA, and Fidelity's FETH, leading the charge. Even Grayscale's ETHE saw a rare positive session, underscoring the broad momentum shift. Currently, Ethereum ETFs hold over $30.17 billion in net assets, representing a significant 5.4% of Ethereum's total market capitalization. While Bitcoin ETFs still manage a larger sum, with $144 billion in assets under management, AUM, equivalent to 6.5% of Bitcoin's market cap, the recent flow dynamics reveal a clear preference for Ethereum. BlackRock, a dominant force in both markets, has seen its iShares Bitcoin Trust, IBIT, amass $83.5 billion, but its Ethereum ETF, ETHA, is rapidly growing, already holding over $17 billion. Fidelity's Bitcoin ETF, FBTC, also holds substantial assets, but its inflows have decelerated compared to its Ethereum counterpart, further emphasizing the changing tide. Financial advisors are emerging as the most significant identifiable holders of both Bitcoin and Ethereum ETFs, according to SEC 13F filings. In the second quarter, these advisors poured over $1.3 billion into Ethereum ETFs, acquiring approximately 539,000 ETH, a remarkable 68% increase from the previous quarter. For Bitcoin, advisors now manage $17 billion across 161,000 BTC, nearly doubling the exposure held by hedge fund managers. Analysts from Bloomberg suggest that this data, representing only about 25% of total ETF holdings, implies even larger retail and international flows at play. Fox Business estimates that such advisor allocations could potentially unlock trillions in new crypto ETF inflows as portfolio diversification strategies broaden. The market performance of these two flagship cryptocurrencies mirrors this divergence in institutional interest. Ethereum has surged by an impressive 18.5% in the past month, breaking above the $4,500 mark and consolidating near $4,560, buoyed by strong derivatives positioning. Conversely, Bitcoin has experienced a downturn, declining by 6.4% from its recent peak of $120,000 to trade around $113,300. This underperformance is attributed to significant outflows, including $1.3 billion in early August and a $1.17 billion weekly outflow mid-August, marking the worst week since February for BTC ETFs. The ETH-BTC ratio has climbed above 0.04, reaching its highest level this year, a clear testament to Ethereum's escalating relative strength. Looking ahead, the strategic outlook for Bitcoin ETFs appears cautious. Despite their dominant market position, the recent inflow trends suggest a medium-term bearish sentiment for Bitcoin compared to Ethereum. As institutional portfolios rebalance in favor of Ethereum, and without new catalysts like expanded distribution or macroeconomic rallies, Bitcoin might continue to underperform. Investors holding Bitcoin via ETFs are advised to closely monitor the 110,000, 112,000 support level and watch for advisor-led reallocation flows. While Bitcoin's long-term adoption case remains robust, the immediate momentum clearly favors Ethereum. But the story of asset flows isn't just about ETFs. It's about how major players are redefining the very value of digital assets. Are we seeing a fundamental shift in how wealth is preserved? Get ready, because we're diving into how regulators and markets are racing to define Bitcoin's $5 trillion future, and what that means for traditional assets like real estate. Bitcoin's $5 trillion future, regulators and markets in a high-stakes race. As the digital asset landscape continues its rapid evolution, a fascinating debate is emerging. Could Bitcoin potentially usurp real estate as the primary vehicle for wealth preservation? This provocative idea, championed by venture capitalist Balaji Srinivasan, is gaining traction, grounded in Bitcoin's inherent scarcity, unparalleled portability, and digital nature. These attributes offer distinct advantages over traditional physical assets in an increasingly digitized world. This perspective aligns with a broader industry trend that sees Bitcoin's infrastructure maturing and institutional adoption accelerating, positioning it not just as a speculative asset, but as a fundamental store of value. Reinforcing this view, JPMorgan analysts have highlighted Bitcoin's declining volatility, which has reached historical lows. This stabilization makes Bitcoin increasingly attractive to institutional investors seeking less volatile, more predictable assets. Their analysis indicates that Bitcoin's volatility relative to gold is at its lowest point ever, suggesting it requires only twice the risk capital of gold for portfolio allocation. Based on gold's approximate $5 trillion private investment market cap, JPMorgan projects that Bitcoin could reach a price target of $126,000 if its market cap were to grow by just 13% to match gold's valuation. This implies significant untapped upside potential, even at current price levels. The integration of Bitcoin into corporate treasury strategies is another key indicator of its growing acceptance. JPMorgan reports that corporate treasury purchases now account for over 6% of Bitcoin's total supply. This trend draws parallels to the post-2008 quantitative easing by central banks, which stabilized bond markets by locking assets into passive holdings. Similarly, passive inflows into Bitcoin are being amplified by its inclusion in major equity indices. MicroStrategy's inclusion, for example, has attracted substantial new capital, and other firms are actively exploring similar strategies to bolster their Bitcoin holdings. Regulatory developments are also playing a crucial role in shaping Bitcoin's future. In the United States, legislative proposals like the Genius Act and the Clarity Act are being introduced to clarify the status of stablecoins, custody rules, and tokenization processes. These initiatives are vital for ensuring that U.S. financial firms remain competitive on a global scale in the digital asset sector. Meanwhile, the European Union has already enacted its markets in crypto assets (MiCA) regulation, establishing a clear framework that is expected to attract institutional investors by providing much-needed legal certainty. Across Asia, hubs like Singapore and Hong Kong are actively positioning themselves as centers for blockchain innovation, carefully balancing regulatory oversight with market access. Complementing Bitcoin's role as a store of value, new digital asset models are emerging that aim to replicate the benefits of traditional investments. Projects like Avalon X are marketing themselves as digital real estate, offering fractional ownership and potential cash flow through utility tokens. These platforms leverage blockchain technology to lower the barriers to entry for real estate investments, incorporating features like fractional ownership and staking rewards. While Bitcoin primarily serves as a digital store of value without direct yield, tokens like Avalon X aim to provide tangible benefits such as discounted services and investment returns. This dual approach, Bitcoin for preservation and innovative tokens for growth, mirrors established wealth management strategies. As Bitcoin continues its trajectory toward mainstream financial integration, its role is poised for expansion. both analysts and regulators recognize the imperative of creating a regulatory environment that fosters innovation while ensuring investor protection. The United States, with its robust financial infrastructure and thriving technology sector, is uniquely positioned to influence these global rules. However, the competitive landscape is intensifying, with nations like China actively promoting alternative digital currencies such as central bank digital currencies, CBDCs. The outcome of this global regulatory race will undoubtedly shape the future trajectory of digital assets and their integration into the broader financial ecosystem. While the big picture is being defined by regulators and institutional adoption, on the ground, a different battle is playing out. Can retail investors hold the line against a tidal wave of institutional selling? We're about to find out as we examine the surprising retail buyers propping up Bitcoin amid a whale-driven sell-off. Retail resilience: buyers prop up Bitcoin amidst whale sell-off. Bitcoin BTC has navigated a challenging period, recently climbing to the $111,000 mark as the US dollar index, DXY, dipped to 98.16. This movement signals potential shifts in market dynamics and investor sentiment, though the overall trend for Bitcoin remains under pressure. Despite a short-term downtrend, a crucial segment of the market, retail traders, has stepped in as net buyers during recent price dips, providing essential support. Data from Hiblock reveals that retail traders on platforms like Binance and Coinbase have collectively purchased over $101 million in Bitcoin spot markets. In stark contrast, larger institutional investors and whales have continued their roles as net sellers, with their selling pressure offsetting the buying interest from smaller traders and contributing to the ongoing market consolidation. The price action of Bitcoin is closely intertwined with broader macroeconomic trends, particularly the performance of the US dollar index. The DXY's fall below the 98 level to 98.16 historically correlates with a relative strengthening of Bitcoin against the dollar. This inverse relationship typically occurs when the US dollar weakens, making dollar-denominated assets like Bitcoin more appealing to global investors. However, despite this potential macroeconomic tailwind, Bitcoin's vulnerability persists as long as larger players continue to divest their holdings. Over the past week, Bitcoin's price behavior has exhibited signs of stabilization. Following a sharp sell-off that pushed prices down to $108,665, Bitcoin managed to reclaim the $111,000 level, establishing a short-term floor. Liquidation heat maps from Hiblock identify key support clusters between $111,000 and $110,000, with another significant cluster located near $104,000. While a breakdown below $104,000 is considered less likely, the sustained dominance of large-scale selling remains a primary concern for market bulls. Analysts caution that without a reduction in net selling pressure from whales and institutional investors, Bitcoin could face renewed downward momentum. Investor sentiment appears to be undergoing a noticeable shift, with capital increasingly flowing away from Bitcoin and towards Ethereum, ETH. ETH-linked products are attracting substantial inflows, contrasting sharply with the significant outflows experienced by Bitcoin ETFs, which recorded over $1 billion in net redemptions last week. This capital rotation suggests growing confidence in Ethereum's underlying fundamentals and its ecosystem, particularly in light of recent regulatory clarity for stablecoins via the Genius Act. Analysts attribute this trend to Ethereum's expanding adoption in decentralized finance, DeFi, and the tokenization of real-world assets, both of which are enhancing its utility and role within the broader blockchain space. The current market structure for Bitcoin indicates a critical inflection point. The price action suggests a potential period of consolidation within the $110,000 to $120,000 range, or a breakdown towards psychological support levels around $105,000 to $100,000. The outcome hinges significantly on the strength of retail buying interest versus the intensity of institutional selling. While the anchored cumulative volume delta, CVD, indicates a slight positive bias from retail traders, the overall market structure remains susceptible to a breakdown if larger players continue to dominate the sell side. A sustained upward trend for Bitcoin would likely require a notable shift in investor behavior, particularly from institutional actors. In the broader cryptocurrency market, performance has been mixed, with Ethereum demonstrating strength and outperforming Bitcoin in recent months. Ether's surge to a new all-time high of $4,956, despite a slight retreat, shows strong buying momentum. Other major cryptocurrencies like BNB and Solana have also shown resilience, with BNB reaching new highs and Solana forming bullish chart patterns. However, Bitcoin's relative weakness highlights its current precarious position, dependent on the ability of smaller investors to sustain price levels against the pressure from large-scale sellers. So we've seen institutional shifts, ETF flows, regulatory races, and the resilience of retail buyers. What does it all add up to? Let's quickly recap the biggest stories and make sure you're subscribed so you don't miss what's next. And that's a wrap on today's critical updates. We saw the 2025 altcoin season pivot to institutional and political power, Ethereum ETFs dramatically, performing Bitcoin ETFs with massive inflows as Bitcoin ETFs faced outflows, regulators and markets racing to define Bitcoin's $5 trillion future amidst global competition, and retail buyers stepping up to support Bitcoin against whale sell-offs, creating a key market inflection point. Don't miss out on the next big move. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, drop a comment below with your thoughts, and follow us on all our social channels for real-time updates. We'll see you in the next one.